Today's lecture, we're going to go over lessons from capital market history. So we're going to focus on two things. Number one, how to evaluate securities in terms of their returns and risk. Two is understand market efficiency theory. You might be interested in stock investment. So let's look at what you might to expect. Take example of 2013. The overall market is going up and some of the winners doing even better, but there's also some of the other players doing pretty poorly. So what do we learn from this example? Stock investment is risky. So our main purpose in this lecture is help you to understand the security performance in the past nine decades of the market history. So how do we compare evaluated securities? Security performance can be summarized in two aspects. Number one, returns, profit. Number two is the risk, up or down. So give you a view of the data we found from the market history. So we picked 7 categories: large company stock, small company stock, long-term corporate bonds, long-term government bonds, intermediate-term government bonds, U.S. Treasury bill, inflation. So we summarize two measures. One is average returns, the other is standard deviation, the risk measure. So we will come back later after we discussed how we compute these each measures. Now let's talk about the return and profit. So the return can be expressed in two ways. One is dollar amount. Say last year you made $20,000. Wow, impressive. Or you can talk about the percentage. Say I earned 15% in my 401k investment. Now the dollar return can also come from two sources. One is the income you received in the form of a cash dividend or the capital gain or loss when you buy or sell stock. The total amount dollar returns divided by initial amount of investment, so we can convert to the percentage returns. So the percentage return can also decompose two components. One is dividend yield, the other is capital gain yield. Let's take a look at one example. Suppose you have stock investment. You purchased at $35 today, and 1 year later, you sell it for $40. So you gained $5. This is called capital gain. Meanwhile, you also received $1.25 in the form of a dividend. So your total dollar return is $6.25. The initial amount of money you spent is $35. So divide by 35, you will convert to the percentage returns, dividend yield, and the capital gain yield. Another example, the bond investment. Suppose today you spend $1,000 purchase one bond. 1 year later, you sell the bond at $9.50. So the price went down, so you lost $50 in terms of capital gain, that is capital loss. You also received 2 coupon payments. Each one is $30. So your net total dollar return is $10. 60 is 2 coupon payment, negative 50 in the capital loss. Your initial amount of investment is 1,000. Divide by 1,000, you can convert to percent returns, capital gain yield, and dividend yield. One thing I want to pay attention to is the capital yield can have positive and negative, while dividend yield typically is positive or 0. Now, after we learned the return measure, let's go back, take a look at historical performance on the 7 categories. So the data computed from the past 9 days, the average annual return is as follows. So let's take a look at which one is top winner. As you see, small stock on average have 16.9% annual return. So that's our first winner, followed by return on the large company stock. Then we have the bonds. long-term corporate bond, followed by long-term government bond, then intermediate-term government bond. Lastly, T-bill treasuries and inflation. That's why you see you will be very interested to say a small stock seems like a top performer. But we also understand there's a risk involved in stock investment. For taking this additional risk, how much compensation we have in terms of return gaining. You want to compare the performance in small company stocks to a safe investment benchmark such as U.S. Treasury bills or T-bills. Compare the T-bill with 3.5. Small stock will give you 16.9, which means it's additional 13.4%. So small stock is riskier, but you earned additional 13.4% compared to a safe benchmark. So that's why there's a measure called risk premium. It's very, very useful and widely used in practice. So what is risk premium? Basically, compared to a safe benchmark like risk-free, how much additional return or excess return you are getting for the additional risk you are taking. So that's why risk premium also has additional name called excess returns. So how do we find the risk premium? Simple. Just subtract risk-free returns. Okay, we discussed the risk premium for small stock. Similarly, you can find out the risk premium using the return subtract the treasury bill T-bills. So typically, the risk premium or average return, they are all very similar in terms of ranking different types of securities because after all, risk premium is only subtracting a constant term, which is treasury bills. Another aspect of security performance evaluation is how risky they are. We do want more returns, but we also want to stay away from risk, right? So the second aspect of performance measure is the variability or risk. So we're going to figure out a measure called a standard deviation, which is a common measure for understanding risk. Come back to our summary table. So we did ranking the securities in terms of average return. Now I want to ask you to take a look and rank again in terms of standard deviation, or how risky they are, or how volatile they are. So as you see, small company stock has highest standard deviation, followed with large company stock. The long-term corporate bond, the government bond, they tend to flip sides in terms of ranking. So we do have the long-term government bond has a bit higher standard deviation compared to long-term corporate bond. Then follow the intermediate government bond and the inflation and the treasuries. One of the reasons why these two rankings are different could be due to the tax exemption treatment in the government bond. Although pre-tax on average it's a bit lower, but after tax adjustment for tax exemption treatment, they could be a bit higher compared to the corporate bond. Let's figure out the standard deviation measures. How do we calculate this? This name called historical variance because the stock or the securities we are dealing with is all already historical data. And they all occur at the same frequency, annually, monthly, or weekly. To figure out standard deviations, I would say you need 3 steps. Step 1, figure out the average return. Step 2, find out variance. Then step 3, take a square root to get a standard deviation. Recall, standard deviation is our risk measure, not variance. Here is one example. You are given 4 annual returns. So how do we figure out a standard deviation? So step 1, we add them up, divide by 4 to get average return. Step 2, we plug into the variance formula. Use the annual return, subtract the average return, then take square. We do this for every single annual return. After we add them up, we divide by the number of the years, 4, subtract 1. So this gives us variance of 0.0015. After you take a square root, so you got a standard deviation, for this example, is 3.87. You could also use a table format to compute the standard deviation. From the annual returns, get average return, take a deviation, then square. In the end, you add up, divide by 4 minus 1. So we finished the discussion. There are two measures to evaluate a securities. One is average, the second is standard deviation. So once we figure out two measures, what can we do with this? What can we learn from these informations? Okay. Suppose the security you are talking about follow a bell-shaped distribution, which means normal distribution. Now this is going to help us to know more about these predictions. So there is actually some supporting evidence to show that securities such as a large company stock, they follow pretty much very typical or normal distribution. So we feel comfortable to use normal distribution to understand the return and the risk performance. So this is our typical famous normal distribution and the three probability windows. One standard deviation away corresponds to third probability window. 2 standard deviation away from the mean means 95% probability window. Then we also have a 3 standard deviation away for the 99% window. Now, our large company security has average 12.3. One standard deviation is 20%. So if we are talking about the 95% window, 2 standard deviation is 20% times 2. So we're going to look at the upper bound and the lower bound. From this data, we found out the 95% window has lower bound is negative 27.7%. The upper bound is 52.3%. So how do we understand this? Means more than 95% chance if you invest in the large company stock, if the data continues like the past history, your performance most likely will be 95% chance above this negative 27.7%, below 52%. Sounds pretty reasonable, right? So the odds of you beating the market, the odds that your performance beat 52% is 2.5%. The odds you hit a huge recession or crisis below negative 27.7% is also 2.5%, right? So this add up 100%. A note regarding two types of the average measure. One is arithmetic average, the other is geometric average. So how they differ from each other? So the arithmetic average is the simple average we use all the time. Simply add up, divide by the number of the frequency. Now geometric average is different. They more consider the compounding effect. Means you earn return on the past profits. So geometric average is different measure. We're going to use 1 plus R annual return, keep multiple, and in the end, raise the power to 1 over t, subtract 1. So which one's better? Both measures are biased. The arithmetic average is too high, too positive, while the geometric average is too low. So in practice, the normal recommendation is if you have a very short-term investment, less than 20 years, we recommend to use arithmetic average. If you have a long investment, then compounding effect is more significant. Go with geometric average. It is also very common use a mixture of both measure, say, 40% and 60% to get a weighted average measure. Come to our calculation part. So 3 annual returns. The simple average is adding up divided by 3. Now the geometric average, we use 1.05 times 1.97 times 1.12. The whole thing raised power 1 over 3, then minus 1. So this is pretty much the reviewing the historical performance for the 7 different security category. And now I'm going to move on the efficient capital market hypothesis. So is the capital market efficient? Why do we care if they are efficient or not? It does matter. If you are an investor, you think, oh, should I just go with index fund? Or should I go to mutual fund because they have no experts and keep searching, looking for picking stock and making additional returns? So if it is true, a market is proved to be efficient, now the stock price are pretty much fairly priced. So that's why a lot of people go with index fund investment. Now, if the market is not that efficient, which means that they do have mispricing opportunities. So if you're actively searching, spot some mispricing opportunity, act on that, yes, you might get abnormal returns. So this is a justification why mutual fund managers or other investors actively manage their portfolio. When information is announced, sometimes we see immediately this reaction, so quick reflected in the security price. No delay, no overreaction. So that's some phenomena we normally observe in a very efficient market. Sometimes we see that information come out slowly, or there's overaction or correction. So what makes the market so efficient? So investors actively searching for mispricing. Once they spot mispricing opportunities, act on that, make trades and make transactions. This is going to help the market become efficient, move price to more into equilibrium. I want to clarify. So if the market is not very efficient, you may have abnormal returns. However, does not mean you cannot earn positive returns in an efficient market, right? For example, if you buy or invest in small stocks, they are riskier. On average, they guarantee you higher average returns. Now I'm going to present to you the 3 famous efficient market hypotheses: the strong form efficiency, semi-strong form efficiency, and the weak form efficiency. So they are the theories, and you wait for the researchers to prove whether this is true. So there's a ton of empirical evidence, but they did not have reached the consensus yet. Let me first talk to you about different type of information and their common examples. So the private information are not necessarily known to everybody, so that's why a common example is inside information. The current public information, when you conduct a fundamental analysis, look at the balance sheet, income statement, heard about earning announcement, dividend information, so they are all based on the current public information. There's some people engage in the technical analysis based on past returns, movement, correlations, so on and so forth. So these actually using the information based on the past public information. Now, so remember, these are hypotheses, which is not necessarily true. We are just saying, are they true or not? We want to test. So according to this strong form hypothesis, means if it's true, the market is so smart. They know everything. They know public information. They know private information. Okay, so the stock prices, they know reflected all the information already. So when you have the new information, inside information, public announcement, okay, it's not going to affect the market. They already knows. So question: if the market is in strong form efficiency, Can insiders make profit? Some of you say yes. Okay, so don't just go with your common sense. And we assume it's a strong form, which means the market knows everything, including private information such as insider information. So the answer is no. Okay? No additional profit. Now, the second hypothesis is the semi-strong form efficiency. So the security market, so the security prices knows reflected or public available information, announcement, annual reports, so on and so forth. So which means if the market in semi-strong form efficiency, so they don't know the private information. So if the market in this form, can insider make profit? Insider information is private information. Yes. How about fundamental analysis? Fundamental analysis based on public available information? No. So the last hypothesis is the weak form efficiency. So the price only reflects the past public information. So the current announcement, the private information, such insider information, they do still have value. So in this case, insider can make profit, fundamental analysis can make profit, but not technical. You may agree or disagree of these three efficiencies. Remember, so these are hypotheses. It's not necessarily proved or agreed on facts. Okay? So we do want you to understand three theory, and there's a ton of empirical evidence. Study these. Okay, so here's a summarized table. So generally impression, the empirical evidence point the market is between weak and semi-strong. So what we can conclude, learn from efficient market hypothesis. So if the market does not guarantee, does not mean that you cannot make money. You could if you invest in risky investment. Market efficiency cannot protect you from make wrong choice. So this chapter, we visited historical performance of 7 different kinds of securities. We talked about the returns and the risk and arithmetic average, geometric average. We also visited 3 types of we also discussed 3 forms of efficient market hypothesis. That concludes our today's lecture.